Subscribe to our channel and click on the bell button to receive important financial updates faster than anybody else.
Friends, welcome to another video on your channel Profit in Equities. In this video, we'll be talking about a company with improved product mix, impetus towards working capital efficiencies, volume-driven growth, and a strong balance sheet which should propel it in the long term. Please watch this video to know more. Now the company in question is V2 Retail Limited, which is available at Rs 269.55 and the face value for it is 10. Now the ongoing market volatility has opened a bag of opportunities for investors who have been waiting on the sidelines to go long on scripts with good earnings potential and comfortable valuations. One such script that is worth taking note of is V2 Retail, which caters mainly to the price sensitive and aspirational buyers in Tier 2 and Tier 3 regions. The company operates 63 stores spanning 7.3 lakh square feet of retail space, primarily in the northern and eastern states. Its verticals include menswear, ladies wear, kids wear, and lifestyle products. Now the management, in a bid to strengthen its network, plans to double the existing store count to about 125 to 130 by mid FY20. Consequently, the company's retail space will expand to 1.05 million square feet, thus driving revenue growth. To facilitate the supply of apparel to mom-and-pop stores, particularly in smaller towns of its target markets, the management plans to start a B2B platform. Benefits of last-mile connectivity and a wider customer reach will be visible by way of an improved top-line performance. Besides, to improve supply chain processes, 2 new distribution centers will be set up, one in Kolkata for the eastern cluster and the other in Bangalore for the southern cluster. Reduced dependence on external warehousing and efficient inventory management practices should have a positive rub-off on margins. Since owned brands fetch better margins vis-a-vis other brands, efforts are underway to increase the share of these to annual sales. The contribution of private label garments, which presently stands at 15 to 20%, is slated to increase to 30 to 35% over the next 2 years. Now, to enhance product visibility, the company is likely to boost its marketing spends and hire a brand ambassador. Onset of the wedding and festive season in H2 FY19, coupled with an uptick in commercial activities ahead of the 2019 general and assembly elections in India's hinterland, is a positive opportunity to cash in on. Owing to the availability of adequate liquidity to fund capex plans, the company should be able to maintain healthy bottom line margins. This is because the need to rely on borrowed funds, which are costlier to raise in the current environment, is low. Also, the company has not much of a threat from biggies in the sector such as Aditya Birla Fashion Retail, Fashion at Big Bazaar, and Reliance Trend, among others. Easy access to credit, greater awareness about product brands, higher disposable incomes, and wider penetration of organized retail channels suggest that growth momentum in semi-urban and rural India remains intact. The company, by virtue of its robust presence in such areas, is well positioned to reap the benefits. Now, stiff competition from unorganized players may necessitate downward price revisions from time to time. It remains to be seen on how the employee costs and promotional expenses that are expected to spike in the near term normalize without impacting margins. The company is not immune to some degree of seasonality. Generally, the second half of a fiscal year tends to witness better demand traction compared to the first half. Now, network augmentation and improved product mix, impetus towards working capital efficiencies, volume-driven growth, and a strong balance sheet should work in the company's favor in the long run. The stock trades at an undemanding 13.7 times its 2-year forward earnings, which is considerably lower than its peers. Given the prospects of a meaningful re-rating, investors are advised to capitalize on the persisting price weakness. Now friends, please don't consider this to be a recommendation on our part. This research was published on a financial website and we'll be providing a link to the article in the description section. Thanks for watching, and if you have not yet subscribed to the channel, please consider doing so.